Hi everyone, I'm Viviana. Welcome to MacroMicro webinar, Dr. Yardeni's Outlook for 2025. At MacroMicro and Yardeni Research, we're focusing on making data more accessible and turning numbers into meaningful insights. Joining us today is Dr. Edward Yardeni, President of Yardeni Research and the author of Predicting the Markets. With over 40 years of experience as an investment strategist and economist, he has advised top institutions and provided market insights for all investors. Let's welcome Dr. Ed.
Thank you very much.
Good to have you here. How's your day?
Everything is wonderful. Thank you.
Okay, so we have a lot of topic to talk about. So now let's just dive into the topic today. And
Sure.
we know that recently the global financial market have been highly volatile, driven by key events like the FOMC decision to pause rate cuts in January, today's higher than expected inflation data, and a sharp downward reversion in labor market data, and most notably, Trump's wave of executive orders and new tariffs. So without further ado, let's dive right into one of the most hot topics, which is tariffs.
Sure.
Okay. Trump signed 26 executive orders on his first day. By the time we were having this webinar, there were over 60. These covers tariffs, AI, energy, and immigration.
Everything, yes.
Yeah, and tariffs is the main focus. First on Canada, Mexico, and China, and more may follow for the EU and some industry this week. And he also signed orders to cut immigration and boost AI and so on. So before we start to analyze the economy, let's start with a very simple question. Dr. Ed, do you think that tariff is a good idea?
Generally speaking, no, but that's in a perfect world. In a perfect world, there'd be no tariffs and trade would be absolutely free without any import duties whatsoever. But we live in an imperfect world, and some countries have been taking advantage of the World Trade Organization's rules, which have tried to create an environment of free trade. And so there have been trade tensions. And the United States, at this point, under President Trump, is using tariffs as a way to try to negotiate deals, not just the United States, but really everybody. You know, he is a deal maker, and in a deal, everybody leaves the room happy, satisfied that they got something. I think that raise our tariffs in countries that have high tariffs on us, and then to negotiate decline in those tariffs. So I think from a negotiating standpoint, they are useful, but I certainly hope that they don't last very long, and I hope that there are a lot of deals that the Trump administration makes to lower them around the world for everybody's benefit.
So it's more like a negotiation tool, but what the market is wondering is that Trump's tariffs on China makes sense because he has been criticizing China's trade policies for years. But
Right.
this time, why target like Canada, Mexico, and possibly EU, the US traditional allies? What do you think Trump's objective is? What do you think he wanted to get through these negotiations?
Well, you never know until the deals are done exactly where he was going, and then it may turn out that that wasn't what he had in mind originally. As you know, he can change his mind quite a bit. During the campaign, he was talking about putting a 60% tariff on China. Now it's 10%. And there really wasn't any discussion of 25% on Canada and Mexico. But I think he's getting their attention. And I think it's not just about the trade deficit. It's not just about leveling the playing field in trade with Canada and Mexico. It's also about national security, particularly our borders. And so we did see that he threatened 25%, but then very quickly postponed those tariffs for 30 days because both Canada and Mexico very quickly gave him something. And what they gave him is promises to do a better job of protecting the borders so that the United States doesn't have to deal with a lot of illegal immigrants and a lot of drugs coming into the country. We'll see what happens in 30 days. But again, he at first said 25% on Canada and Mexico across the board, and then he postponed it. But now he's implemented 25% tariffs on steel and aluminum for everybody, for all countries, including Canada and Mexico, and they are big input to the United States of steel and aluminum. So I of it has to do with national security. A lot of it has to do with American interests trying to make sure that other countries acknowledge that there's been some unfair practices that need to be corrected.
Okay, so it goes beyond trade deficit. It goes to like
Yes,
national security and all
that's
that other issues. Okay,
yeah,
so
exactly.
the question I believe that all investors are trying to figure out is that who wins and who loses. Like
Mhm.
during the Trump's first term, he focused on China, and then it allowed many emerging Asian countries like India, ASEAN countries, and Taiwan to benefit. Will it play out the
Yes,
same way this time?
it could. I mean, clearly during Trump 1.0, during the first term of the Trump administration, the main focus was really on China. And China really was the loser. But China adapted very quickly. And we did see that a lot of Chinese production moved to Vietnam and Mexico. And so, net, it's not clear that much was achieved by Trump 1.0. And when we're talking now about Trump 2.0, you're right. It's not just about China. And China, instead of 60% tariff, as he was talking about during the campaign, is now 10%. And the Chinese response has been fairly diplomatic, fairly muted. They have responded, but not in a way that leads to ongoing escalation of these trade wars. I think the ideal situation is that Trump is using tariff and tariff threats to make trading partners recognize that the United States is watching the relationship on trade, on national security very closely, and wants to have discussions about how everybody can benefit. Again, Trump is the deal maker, right? He wrote a book called The Art of the Deal. And in a good deal, both sides of the table feel like they've achieved something. And I think if the achievement would be lower tariffs, which is very possible, but they have to be negotiated down. So that's really what I see happening here. So I don't think this is going to be anything similar to the tariff that created the Great Depression back in the early 1930s. We had the famous Smoot-Hawley tariff, which caused worldwide depression because there was ongoing retaliation for the U.S. tariff. I don't think this is where this is going. And so far, the stock market seems to agree with me. Back then, the stock market actually declined sharply in 1929 and early and mid 1930 because the investors realized that the Smoot-Hawley tariff was going to be a disaster. So far, the market, I think, is handling this tariff talk reasonably well.
So, who do you think Trump wants to have a deal with next? What industry or what country will be targeted next?
Well, I think everybody's targeted now, right? Because he said that he's looking at every country and our relationships with every country. Now, not every country has significant trade relationships with the United States, but I know that the Prime Minister of India is coming to have a meeting with Trump, and they are going to be discussing tariffs because India does impose high tariffs on U.S. importers. So I think there'll be some discussion about that relationship. But other than that, the big ones are China and Mexico, Canada, and then you start looking at things at the EU. The EU, I think there's again more than just an attempt to deal with trade relationships. There's also national security, and Trump has said and saying again that the U.S. expects that the Europeans will spend more on defense, so maybe the United States doesn't have to spend quite as much.
So, to sum it up on the tariffs, Dr. Ed's view is that the Trump tariffs is not as threatening as people think because it is still plenty of room for negotiations for now.
Yeah.
I mean, in a perfect world, there won't be any tariffs, but we're
Correct.
not in a perfect world. So eventually, we'll just have to wait and see to see what turns out
Absolutely.
among these negotiations. Okay.
Yeah,
So,
I think you're right, and I think investors still have to have an opinion of where this all goes. And at this point, I'm not that pessimistic that this will lead to a major global trade war. Quite the opposite. I think it will sort of make people realize that we do actually have rules in an organization called the World Trade Organization that is premised on the idea of freer trade. And I think all Trump is doing is saying that trade hasn't been all that free, and other countries have taken advantage of the free trade system, and it's time to call them out and ask them to play by the rules.
We might even get a result to a better world where both sides get benefits and we have a more even trade. Okay,
correct.
Okay, moving on to the next topic. The reason why Trump's policy generates so much discussion is that investors ultimately focus on the performance of U.S. economy. So let's talk about the U.S. economy. Last night for us, which is the morning for you, the U.S. CPI data was released and it was above the market expectations with the annual growth reaching 3%. Yeah. Okay, so this led to another drop in the stock market. Dr. Ed, do you think inflation is something we should be worrying right now?
Well, I think the U.S. economy is performing very, very well. With regards to your question on inflation, I think inflation clearly has come down dramatically since 2022. Back then, a combination of the impact of pandemics on supply chain, the impact of Russia invading Ukraine, the impact of very stimulative fiscal and monetary policy in the United States all led to a big surge, spike in the inflation rate that peaked in the summer of 2022. Back then, we thought that it would come down rather sharply because we thought that supply chain issues would be resolved and would bring inflation down. We did think that energy prices would lead to supply and would back on demand, and that would bring oil prices down. So look at the CPI, there's goods and there's services. And within goods, there's durables and non-durables. Non-durables includes oil and energy and food. And so goods side of the CPI has behaved very well. Durable goods inflation actually turned into slight deflation. Durable goods prices have been falling a little bit. Non-durables, food and energy, that inflation rate basically has been a little bit above zero. Now, in this latest CPI, we did see some pickup in non-durable goods deflation. In other words, durable good prices aren't falling as quickly as before. And we did see late last year, early this year, an increase in energy prices, but now they seem to be heading back down. So I don't think we really have a problem at all in the goods side. The problem has more been in services, and there are a lot of various components there that can go their own way. So we had motor vehicle insurance was the big contributor to inflation. Then the CPI has a ridiculously large weighting in shelter and rent, and rent inflation is coming down, but slowly. So I think right now the CPI seems to be stuck around 3%, which is not a terrible level when you consider that the Federal Reserve actually focuses on what is called the PCED, the Personal Consumption Expenditures Deflator, which is a better measure of consumer inflation than the CPI. And the PCED inflation rate tends to run a little cooler than the CPI. So the CPI is hot at 3%. The PCED is probably running around 2.5%. So that's not too bad. The goal is to get it down to 2%. And I think the Fed recognizes that maybe they need to stop lowering interest rates, leave interest rates where they are, and let economic forces continue to bring inflation down. And I think productivity is already making a comeback, and that'll be a big source of that. And if productivity is making a comeback, then that suggests that the U.S. economy, in terms of real GDP, will continue to perform very well. For the past 3 years, we've had what I call the most widely anticipated recession of all times that never happened. It was the no-show recession. It just didn't happen. And I think we were among the few, if not the only ones, saying that there would not be a recession that the economy would turn out to be resilient. And so I think the fact that it has been resilient is important to recognize, because it does suggest that the economy can put up with some shocks. It put up with a shock of the federal funds rate going from 0 in March of 2022, and then by 2023 getting up to 5.5%, and staying there until August of 2024. And yet the economy continued to grow. So here we're having the shocks of Trump 2.0, tariffs and deregulation and government restructuring. I think the U.S. economy is going to handle it reasonably well. So put it all together, and I think we continue to have an economy that performs well, with real GDP growing by at least 3%, maybe more if productivity makes a comeback. And if I'm right about productivity, then inflation won't be a problem either.
So the CPI data that we're seeing now is not something that we will be worried about right now, because considering the PCED, a better measuring tool, is at a level that is acceptable, and especially when the U.S. economy is showing resilience on the this level of the inflation. Okay, so since we're talking about the economy, shifting our focus to the job market, back in January, U.S. non-farm payroll increased by 143,000, but it is below the market expectation. However, at the time, the revision to the previous 2 months also added 100,000 jobs, bringing a 3-month average to a solid 237,000, which is indicating a continued labor market strength. So how would you interpret this data?
Yeah, well, I think you got all the right numbers, and I think you put it in the right perspective. You can't just look at the latest number, because it's prone to be revised, and we know that it's revised at least twice, and then once a year it's revised again. So it's really a moving target, and so you have to look at a lot of the labor market indicators. Jobless claims, initial unemployment claims have remained very low. The jobs plentiful surveys that we get from the Conference Board and that we get from the Bureau, from the Small Business Survey, all those really suggest the labor market's in good shape. I think we actually have a shortage of skilled workers, and that's one of the reasons I think productivity is going to make a comeback, especially with the technologies that are out there that can improve and augment the productivity of workers. At the same time, wage inflation is relatively it's moderated, and when you adjust it for prices, you see that real wages are increasing, which is very good, because it's good for the consumer, and it's also an indication that productivity is growing. Real wages don't go up unless productivity is going up. So again, I look at the economy, and I see an economy that's doing well, and most importantly in the labor market, because that obviously affects Fed policy. The Fed has its dual mandate of keeping the unemployment rate low at full employment, and we're at 4%, so that's pretty good. You mentioned all the labor market indicators. The 4% number also came out in January, and that was a very good number, and another reason for the Fed not to lower interest rates anymore. And the inflation news is still a little sticky, but it's sticky between 3 and 2.5%. It's which is pretty close to 2%.
Okay, so it's basically same as our perspective. The labor market is still in a good shape. Since we're talking about productivity, and we know that productivity originates somewhat from the workforce, so let's look at the longer term impact. How would Trump's immigration policies affect U.S. labor supply, and in turn, the future unemployment rates? What do you think about this, Dr. Ad?
There's a lot of moving parts in our economy these days, literally moving parts, because administration working on deporting a lot of workers, so that and we have seen a tremendous slowdown in the number of migrants crossing the border into the United States. Now I think we're pretty close to net seeing more people leave than coming in. We're getting pretty close to that. We may be actually close to zero right now. So that will affect the labor force. The revisions in the labor market data were recently related to the government realizing there's more immigrants, in the foreign-born people in the labor force. Not all of them illegals. Obviously, some that are legal, but it just again speaks to the problem we have in the labor market, which is a shortage of workers, a shortage of skilled workers, and this is actually a worldwide problem. China's no longer has a lot of inexpensive workers. Maybe Vietnam and Mexico have, but those wages are going up. And so I think we live in a world now where we need to increase the productivity of workers. And fortunately, the technologies to do that exist. This is not technology that will replace workers. It's technology that will make them smarter, better. A few centuries ago, we had the agricultural revolution and the industrial revolution, and that was all about the physical aspects of work. The digital revolution that started in 1950 is all about the brain. It's about making our brain smarter by allowing us to use technology to increase the speed at which we can process a tremendous amount of data and come to conclusions about how to increase productivity, how to improve customer relationships and service. We can do that much faster now. And I think it's going to be the combination of the human systems like artificial intelligence, robotics, automation, that are all going to boost productivity. So I've been arguing since 2019 that we may very well look back at the current decade, call it the roaring 20s, like the roaring 1920s when productivity was boosted by technological innovations. We have the same situation now. And so far, so good. We're halfway through the decade. And I think with real GDP at a record high, personal consumption at a record high, stock market at a record high, we've been in at least half the decade has been pretty good. Not that we haven't had problems, but looking ahead here, I think the economy continues to deliver prosperity because of thanks to productivity and technology.
Okay, so it's all came down about the productivity of the workers,
yes.
And thankfully we have the technology is advancing day by day, so we don't have to worry too much about it right now. Also, another point of view is that we think that the labor market has turned into equilibrium by the time. So at this stage, we think that implementing a slightly supply side control is not necessarily a bad thing because it is making the labor market more unlikely to become oversupplied too quickly. So maybe that's another point of view that everyone can think about. Okay, now since we mentioned about the inflation and the job market, so now let's talk about the monetary policy. Everyone is worried about the impact on tariffs on inflation, and we see today's CPI data, and also the latest University of Michigan survey shows that one-year inflation expectation has been rising to the highest in over a year. So my question is that if tariffs do push up U.S. import costs, will Fed continue to pause rate cut or even considering hiking the rates? Dr. Ed, what is your view on this?
Yeah, I think the short answer is yes. If tariffs push up inflation, the Fed certainly is not going to lower rates, and there could be a scenario where the Fed has to consider or actually raise interest rates. Well, let's just think about that for a second. During Trump 1.0, there were tariffs imposed on our biggest trading partner, which was China, and we really didn't have an inflation problem for that. You know, there's a lot of things that can happen when a tariff is imposed. For example, the dollar has been quite strong, and so if we impose tariffs, and tariffs are basically paid by U.S. consumers, but on the other hand, we can buy the products cheaper because of the strong dollar, then the tariffs are offset to a certain extent by the impact of the currency. And then again, inflation is a very complicated process. It can certainly be affected by productivity, by supply chain disruptions, by all sorts of variables. But as I'm looking at it, I think that we're not going to have much of an inflationary impact from tariffs, especially since I think a lot of the tariffs are going to, at some point, lead to lower tariffs. That, you know, we're not talking about retaliatory tariffs. We're talking about reciprocal tariffs. Now, what's the difference? Well, during the 1930s, in the early 30s, the United States unilaterally raised tariffs across the board against everybody, and everybody turned around and retaliated. They raised their tariffs, and there was no mechanism to negotiate any of that. In the current situation, I don't characterize the tariffs as retaliatory. As a matter of fact, the Trump administration is using the word reciprocal. Reciprocal means matching. So what we're doing is we're not increasing our tariffs above what other countries charge. We're matching their tariffs and then saying, if you don't like that, we'll be happy to discuss making trade freer and lowering tariffs. So it's a messy process. We don't know exactly how it's going to play out, but all I'm saying is it doesn't have to play out with higher inflation. It could actually play out the other way, where the world becomes has freer trade, and everyone benefits from freer trade. So that's kind of the way I'm looking at it. If that's the case, then and inflation stays relatively moderate. The question is how moderate. And right now, 2.5% to 3% is not moderate enough for the Fed. They want to see it down to 2%, and they want to see it there, stay there for a while. Now, let's not forget that inflation for many years, the Fed wanted to get it up to 2% and was unsuccessful in doing that. And now maybe we're going to have a hotter inflation rate than 2% for a while without any real reason to view that as a crisis. But it certainly would suggest that the Fed does not need to lower interest rates. As a matter of fact, when the Fed started lowering interest rates in September 18th of last year, we argued that it was a mistake, that the economy was strong, that inflation wasn't quite yet down to 2%, and that the bond yield might go up. We were one of the few forecasters that argued that the bond yield might go up. And it did go up. It went up by 100 basis points, was exactly how much the Fed cut by 100 basis points. And so the bond market was basically telling the Fed that they had made a mistake. And I think the latest CPI numbers, the latest GDP numbers confirm that. So I think the Fed is going to stop lowering interest rates. Now, when you listen to what the Fed is actually saying, I think I would characterize it as a dovish pause. Pause means, we're not going to do anything for a while. Dovish means that they are saying that we're going to stop lowering interest rates for now. But notice they're not saying we're going to stop doing anything with interest rates. They're saying for now, we're not going to lower interest rates, but they are talking about lowering them down the road. And I think they should just recognize that given the performance of the economy, they're exactly where interest rates are where they should be. And so I think a 4.5% 10-year Treasury bond yield is normal, as it was before the great financial crisis. I think a 4.5% Fed funds rate is normal. It's actually a sign that the U.S. economy is very healthy, and it gives investors who don't want to take much, if any, risk an opportunity to diversify into a safe asset like a Treasury security.
Right. So even though we're seeing a rate that is pausing right now, we don't have to be too much worrying because it is more like a dovish rate pause. And also the connection between the tariffs to inflation, there's still a lot of factors that need to be considering. Also considering that the tariffs now we're seeing is more like a reciprocal tariff. So we have to wait and see how it turns out. It might be even a lower tariffs.
Could be.
So let's talk more about federal fund rate, although that Dr. Ed has already given us his view that 4.5% is reasonable. But is that indicating that you expect the rate cuts will stop this year? Or what would be the reasonable terminal rate for this cycle? Not just this year, this cycle.
Well, look, I reserve the right to change my mind, just the way Fed Chair Jerome Powell has that right. But as a strategist, I can't change my mind too often because then I lose my credibility. And so it's been my view that the Fed should not have lowered interest rates by 100 basis points, but they just won't listen to me. What can I say? They've got their own agenda. But now I don't know if they're listening to me. They're recognizing that the position we've been talking about, that the economy is strong and inflation isn't quite yet at 2%, not justifying rate cuts. They acknowledge that, which is a good development. Now, I think that there's still quite a few people at the Fed who thinks that the federal funds rate is restrictive because they have this idea that there's a neutral interest rate out there, and that at which the economy is in nirvana, that you get low unemployment and low inflation. And they think that the neutral rate is closer to 3%. And we know that from the quarterly summary of economic projections that the people at the Federal Reserve, the Federal Open Market Committee, they put that out every quarter, and the average of their expectation for the long-term interest rate is in fact 3%. So I'm looking at the same data as they are. I'm seeing an economy that doesn't really need to see the Fed funds rate go down to 3%. Now, what's so bad about going down to 3%? Well, it may be that we still need to keep rates high just to keep inflation from going up. I am concerned that if the Fed brings interest rates down without that being justified by the economy, that we'll get a melt up in the stock market, which is fun on the way up, but melt up implies a meltdown, and that would be kind of 1999, 2000 all over again. So when I talk about the roaring 2020s, I give that scenario 55% probability. I would give 25% probability to a melt-up scenario like 1999, 2000. And then the remaining 20% is for everything that can go wrong. For a while, I was focusing on geopolitical problems and the potential for a spike in oil prices. That doesn't look like it's going to be a problem. I think another issue, obviously, was monetary policy. I didn't think it was going to cause a recession. What's left? Well, I suppose now we have tariffs to worry about. The tariffs might cause a recession. So again, I don't think so. But that's I have three scenarios, and the third one, I just keep throwing in whatever could go wrong. And so far, I put it all together, and I still have a base case, the most likely case, as the roaring 2020s, and then potential for a melt up. So put them together, that's an 80% scenario for a bull market to stocks with the economy performing well. And just to be balanced and to make sure I don't forget what could go wrong, we constantly examine the factors that might lead to bad times again.
So as for the market reaction, we all know that the rate cut this year is going to be smaller than last year. Dr. Ed, what would you think would be the impact or the market reaction on the stock market?
Well, when you look at the market, I think everybody agrees that the stock market in the United States is not cheap. The valuation multiples are very high. They're quite close to where they were in late 1999. So there's definitely exuberance. Quite a bit of that exuberance is rational exuberance. But as Alan Greenspan said in 1996, how do we know that it's not irrational exuberance? Well, I think we know that valuations are high. And I would not want to see this market go up on valuation, because I think that would just increase the odds of that 1999 scenario, the melt-up scenario. I think that what's going to drive the stock market higher is earnings. And that's because I think, I said before, I expect better than expected growth on better than expected productivity. And if that happens, then S&P 500 earnings could be $285 a share this year. And I think I'm the highest on the street with that number. And then for next year, I'm looking for $320 a share. And then by the end of the decade, 1929, I'm looking for $400 a share. So I can see the market going up, the S&P 500 going up to 7,000 by the end of this year, 8,000 by the end of 2026, and 4,000 not 4,000. That would be a disaster. Let's do that again. 7,000, 8,000, 10,000 by the end of 2029, and driven to mostly by earnings.
To sum it up, the U.S. economy is in a good shape right now, although the valuation multiple is high, but we're seeing the earnings building up to support the valuation, right? So after covering the economic data we talk about and Trump's policy, the next big question is the asset allocation. So in part B, we'll dive deeper to Dr. Yardeni's outlook on financial market this year. So we will discuss the key indicator he's watching and whether he has adjusted stock market targets, including the S&P forecast he just talked about. Right. So starting from a broader perspective, what do you see as the most likely scenario? And you have kept mentioning the roaring 2020s. Can you explain what you mean by that?
Well, the roaring 2020s is obviously an attempt to see the similarities between this decade and the 1920s. The 1920s started out very, very badly. It was very depressing. A few years before that, it was World War I. At the time, it was called the Great War because there was only one World War. And then when the World War I ended in the late, right before the 1920s, 1918 and 1919, there was a Spanish flu, which killed millions of people around the world. And then in 1920, there was a depression in the United States. Back then, they didn't use the word recession; they used depression. But all those things. If you were around in the early 1920s, you must have been extremely pessimistic because everything went wrong. People died from war, from disease, and then they had no jobs. And then it turned out to be the roaring 1920s because of tremendous technological innovations like electricity, like plumbing, like the automobile, and all sorts of other appliances for the house and machinery for industry. And we had a great increase in productivity, and productivity is really what drives prosperity. And so we had people starting to really enjoy life. There was a lot of dancing, there was a lot of parties, and a lot of wealth was created. Now, of course, it ended badly. It ended with a great crash that started in late 1929. But really, it was because of the Smoot-Hawley tariff, as we discussed, that occurred in June of 1930. This time around, similar situation with regards to all kinds of technologies, particularly digital technologies that can increase productivity, that are increasing productivity, and increasing productivity increases the standard of living. Wages go up faster than prices in that kind of environment. Economic growth is faster. We might even be able to get the ratio of the deficit, the government deficit to GDP down. If you get better economic growth, then GDP is going up. And if you get better economic growth, then tax revenues are also increasing. And so that way that we might deal with this problem of the deficit. Again, I have that third bucket of what could go wrong, and a debt crisis is certainly in there. But I'm not pessimistic enough to believe that that's what's going to bring the economy down. Again, I'm impressed by how resilient the economy has been the past 3 years, and I think there will be challenges, but I think it'll continue to meet those challenges and to perform very, very well. So the market goes up, has been going up in the 2020s, just the way it did in the 1920s. I don't anticipate a crash. Could there be a meltdown where the market's down 30%? Of course, there could be something like that. But I think the overall economy will continue to perform well. And if I get this decade right, I may start to talk about the roaring 2030s, but we'll talk again before then.
Right, so the Roaring Twenties really seems like have a lot of similarities on these days, since we just ended the pandemic and now we're fighting the tariff war. But in the 1920s, new technology boosts productivity and create prosperity. And today's similar progress with AI is driving the economic growth. So in our view, we also think that the stock market is primarily driven now by the long-term productivity cycle, and each productivity cycle is led by different industry, I can say that. And this time is clearly about technology and the AI trend.
Yeah.
So now let's talk about the market concern on AI. Do we need to worry about the slowdown in AI investment?
Yeah, well, it's too soon to know. I mean, clearly, Deepseek was a a bit of a surprise, and yet the big technology companies are saying that they remain committed to spending billions of dollars, tens of billions of dollars on AI. Now, some of this is building data centers, and we need data centers whether AI works or not, because we clearly are processing more and more information. I think AI really has to be put in the context of what I call the digital revolution. It started in the 1950s with IBM mainframe computers. Then eventually it became personal computers, laptops. Then it became the cloud, and now we're with AI. I think it's the digital revolution is all about data processing as much data as we possibly can, as quickly as possible, as cheaply as possible. And AI certainly has been an example of the progress we've made in doing exactly that. And we've had to write programs to help us deal with the fact that we can process and find patterns in data so quickly. And so it's still a fairly new technology. I think that if the information that is fed, the data that's fed to large language models is everything that's on the internet, it's going to be garbage in, garbage out. And I think a lot of the information that is processed by the large language models that are open to the internet will put even more garbage into the internet. But if you use the large language models with pure data that you have in your company, or data that you've bought from other sources that you know has been vetted, has clean data, I think it's a very powerful technology, and it's like that technology that's gets incorporated with other technologies like humanoids, robots, automation, and so things are integrated. They're not. I mean, back in the 1920s, a car was a car, and a washing machine was a washing machine. They had similarities, but you couldn't combine them. You couldn't go for a drive and do your laundry at the same time. Here with robotics, automation, AI, they all work together, and we're going to have cars that are autonomous, which means that we'll be using cars much more productively. Think about how unproductive cars are just sitting in garages or in parking lots. Now we won't have to own cars. We can own them if we want to generate some revenues, but cars will just be, all these cars will be kind of autonomous Ubers. So that's just one example. Humanoid robots, Tesla's working on that. About 40 Chinese companies are working on humanoid robots, and it won't be long before they are incorporated in manufacturing and maybe even in a household setting. So there's a lot of technologies that are here and now. It's almost like science fiction has become real, and I guess that's partly because of Elon Musk, when he was growing up, read a book called A Hitchhiker's Guide to the Universe. And Elon Musk thought that all the science fiction that he was reading was really cool, and he wanted to make it real. And he's been doing that, but so have lots of other engineers around the world. And we're making a lot of progress in converting science fiction into science nonfiction.
Right. So, innovations like Deepseek, which lower the cost, will actually drive greater demand. So we don't have to worry too much about the slowing down in the AI investment. And also, we're seeing major tech firms continue to commit into AI. But what does it mean for China? Is Deepseek a bullish or a bearish factor for the U.S. tech market?
Well, I'm a big believer in free markets and in competition. And at the end of the day, I, I don't care if companies make money or not. I care that they innovate and that they bring us products that increase our prosperity, the consumer. And the way I look at the world, um, I don't look at it as kind of workers versus capital. Certainly not in those terms. I look at it as consumers should be the beneficiaries of a competitive marketplace, and the companies that achieve that bring consumers products that really improve their standard of living, they are going to prosper. And I do want to invest in them, and I do care about them as long as they do that. But I also have to realize that there's always going to be somebody out there that's is a competitor that finds a way to do the prosperous companies today are doing more cheaply, and will force them to either do it better or go out of business. So capitalism, free market system, it works, in my opinion. I'm a big believer in capitalism, but I want to be specific. I'm a big believer in entrepreneurial capitalism, in capitalism that's driven by individuals and businesses that aren't protected by the government, that have to satisfy the consumers, their customers, all the time. I'm totally opposed to what's called crony capitalism, where the companies get together with the government and manipulate the market. This, again, as we discussed before, it's not a perfect world. And in the United States, we have a combination of entrepreneurial capitalism and crony capitalism. We have people in the political arena who are socialists and would like the government to redistribute income more. These are all very complicated issues. They've been complicated and controversial forever. But I think as long as a country has entrepreneurial capitalists, the country will prosper, because entrepreneurial capitalists are always looking to come up with better ways to satisfy the consumer. Because if they do that, they get rich, and there's nothing wrong with that.
Right, so we're still seeing a lot of innovations in the market right now. Now, focusing on the asset allocation, do you think investors should overweight stocks or bonds this year? What ratio would you recommend?
Well, a friend of mine just called me up that I hadn't heard from in a few years. He reached out to me on LinkedIn and said, we haven't talked for a while. And so we caught up on our families and all that. But then he got to the point that he was interested in was that, he's 75. He's got a lot of money. He was an entrepreneur, an entrepreneur capitalist, created a few companies, sold them. They were in the healthcare industry. And so he feels as though he's made a contribution to society, but he's nervous now. He's nervous about all the commotion in Washington, the geopolitics, the uncertainties with the Middle East. And so he asked me what I would recommend. And for somebody his age with his wealth, I said, well, obviously you want to not take a lot of risk. You want to have your capital intact. And so I would recommend a third in stocks, mostly overweighting the U.S. More so than other countries. I would put a third in bonds, and it could be corporate bonds because they have a better yield. And I think corporations, some of them are run better than the government. And then a third would be in some combination of Bitcoin and gold and cash. So the answer to your question obviously depends on the age of the person. So I have 5 children, and my youngest ones have been starting to work and getting interested in the idea of saving and how they should be managing the sums that they're accumulating. And I advise them to take a term view of investing in the stock market. The power of compounding is something that Warren Buffett has talked about. Professor Siegel has talked about it. I've talked about it. It's very hard to trade the market if if you don't have a day job and you know what you're doing. You can make a lot of money and in the market, and then set up a hedge fund and become a billionaire, I suppose. But if you do have a day job, it's hard to trade the market. And if you try to pick tops in the market, you have to remember to pick the bottom too. I would say for younger people, investing in good quality stocks that pay dividends and just putting them away is an excellent way to invest. For traders, we've got research that we call quick takes, where we try to focus on how the markets are interacting with data, kind of the short-term movements in the market. And we've had some good success with that. And so it really depends on the age of the person, their risk tolerance, and how much time they have to devote to focusing on the financial markets.
Right, so it really depends on the investors' investing timeline and their appetite for the risk. But many investors are really attracted to the dividends, the bond yields these years, and the U.S. 10-year Treasury yield is currently around 4.5%. Dr. Ed, do you think this is a reasonable level, or do you think that for example, we're taking the timeline to the end of the year, is it too low or is it too high?
The issue of the debt crisis, right? Because if 4.5% is too low, it's because it's clearly going to go back to 5%. And if it goes back to 5%, why couldn't it go to 5.5%, 6%? And why not wait to buy the bonds? And the reason it would go higher than 4.5% would be because of a debt crisis in the U.S. Right now, the Trump administration has bought some time with my friends, the bond vigilantes. I invented the term bond vigilantes back in 1983, and the bond vigilantes are just kind of watching to see whether this administration is going to do something significant about the deficit. Nobody's talking about balancing the budget. Nobody expects that to happen. But the Treasury Secretary has said that he would like to see the budget deficit down from 6% of nominal GDP to 3% of nominal GDP. I think if they could convince the bond market that they have policies that will move us in that direction, then I think 4.5% is a very good rate. And I don't think you have to. There's no rush to buy it here, but I don't think it's going to change much. I think it's going to remain around 4.5%. This to me is normal, but things can be volatile. We in March, and we're going to have to focus on the U.S. budget. The next U.S. budget political discussions will obviously include Trump's push for continuation of the tax cuts of 2017 and some additional tax cuts on overtime pay, on Social Security, and on tips. So these are all ambitious plans to cut revenues. And I think that's one of the reasons Trump was thinking about tariffs as a way to raise revenues. But I think he's kind of coming to realize that maybe that's not going to work very well. So it's a challenge. Now, it's hard to say how much the Doge committee, Elon Musk's Doge committee, is going to cut the deficit. It's not going to cut it by $2 trillion on a one-year basis. Even Elon Musk has admitted that. Could it cut it by $2 trillion over 10 years? Is it possible that outlays could be cut $200 billion? I think it's possible. And I think if we kind of slow the growth rate of outlays and the economy grows better than expected as we're forecasting, then revenues could come in better than expected. But the short answer to your question is, I think 4.5% on a 10-year basis is a good return. It's a safe return, and obviously you'll get your money back. The U.S. is not going to default. The money is not going to go bad, and so I think it's fine. At the same time, I think being in gold is not a bad place to be, since we know that the foreign central banks, particularly China, Russia, and others, are buying gold, and that explains why the price of gold just keeps going up. Gold is turning out to be a safe haven for central banks of countries that are adversaries of the United States. They don't want to hold a lot of dollars because they fear that the U.S. will do what was done to Russia, freezing its international reserves that are in dollars and foreign currencies. So I think gold is fine. 10 years are fine. I think dividend yielding stocks are fine. I think and having a willingness to have a long-term investment approach is probably going to do quite well, rather than trying to trade, again, unless you're really good at trading, and that's your day job.
Right. So under the scenario where there are no further hikes and also the debt crisis maintains in control, 4.5% yield still seem reasonable. And of course, if the rate cuts continue, there might be more room for the movement, but capital gains are not the primarily reason for allocating bonds. And if you're thinking about asset allocation, maybe gold is also a good option for you to add to your allocation. Okay, so since we have been talking about the debt crisis. Now, let's go to the last topic. Last but not the least, let's talk about the risks. What do you think is the biggest risk for U.S. equity this year?
Well, I think it is the debt crisis. It is the bond market had a mini debt crisis in 2023. In 2023, the bond yield went from 4% in August to 5% at the end of October, 100 basis points in a very, very short period of time. And that was because a few of the auctions selling the bonds did not go well. They were sloppy, and as a result, it took higher rates to sell the bonds. If we see a lot of political fighting in Washington, if it turns out that it's much easier for the president to sign executive orders than to actually get significant legislation that would achieve the goal of, over time, reducing the deficit relative to GDP. If inflation surprises to the upside, a lot of things could go wrong. It's happened before. It could happen again. Just because I have an optimistic base case doesn't mean I'm not aware of, and we are all aware of what could go wrong. So if a lot of things go wrong at the same time, and the bond yield goes back to 5%, then it keeps going, I think the stock market would have a very significant sell-off. But I think that would get the politicians' attention. The federal deficit is a man-made and woman-made problem. We have males and females in Congress that have contributed to this problem. So I think they can solve the problem if they recognize that the bond vigilantes have lost their patience and are no longer willing to sit back and let fiscal and monetary policy be undisciplined. The idea of bond vigilantes is that the financial markets, the bond market, has this ability to say, well, if fiscal and monetary policy can't maintain law and order, can't maintain low inflation, can't maintain speculative excesses, then the bond vigilantes will do it by pushing up yields to levels that scare the politicians into doing what's right. And if they don't do that, then we get a recession, and then we're really in trouble. So, yeah, there's a lot of ways things can go wrong. But as I said, I'm aware of that, and you can agree or disagree with the probabilities I have. I think the three scenarios pretty well describes the three potential outlooks for the economy and for the stock market and bond market. And I have the probabilities we discussed before.
Right, so there's the debt crisis, the political fighting, inflation surprise, and also the valuation issue we talked about earlier on the stock market. All right, so how should the investor monitor these risks? Are there any key data points or indicators that Dr. Ed would recommend us tracking?
Well, they should follow your work and my work, right?
Yeah, so we're trying to narrow it down to, for example, 3 to 5 or to 10 charts or some specific data for users to follow.
Yeah, well, I don't think it's that easy. If it was that easy, I would be out of a job, and you would be out of a job. But the reality is, in any situation, there's a lot going on that influences the markets. But if you forced me to answer your question, I would say I would definitely want to have a chart or two on commodity prices. Definitely want to look at oil. Definitely want to look at copper.
Right.
Look at overall commodity prices as a indicator of global economic activity. So that's that. You want to start at the global level, and I think commodity prices can be very helpful in getting a sense of that. So if you suddenly see copper prices going up, you could ask yourself, is something changed in China? So then you go look at the China data. So there's like maybe primary data then secondary data that kind of tells you where you want to go next to get a better ID. And so if you see copper prices going up, then you go look at some of the data out of China on retail sales, industrial production, loan demand, read about what's going on in the property market, and you don't see that China's getting better, then maybe there's something else going on, or maybe it's just not a sustainable move. And so that would kind of alert you that something's going on, but it's not fundamentally based, and it may be reversed. With oil prices, again, it's pretty hard to forecast them, but it's pretty useful to use them as an indicator of what's going on in the global economy. So when you see geopolitical situations, particularly in oil-producing areas like Russia and the Middle East blowing up, and you don't see the price of oil going up, but instead it's going down, then again, you ask yourself, what's going on the demand side? Are we getting more supply? The United States producing? Of course, then commodity prices give you a little bit of a head start on thinking about inflation. And, we always want to have some idea of inflation. My best indicator for inflation is frustrating because it's only available quarterly, and that's unit labor cost inflation. Unit labor cost is hourly compensation. It's wages, salary, benefits, what people get in their paycheck, there's benefits, divided by productivity. And it's a very good indicator of the underlying inflation rate in the labor market. So I wait for that data. It also tends to be revised. So, there's a little frustration there. With regards to the U.S. economy, again, and unemployment claims and continuing claims are very helpful in getting a clue as to what's happening in the labor market. But it's not the whole story. Initial claims tell you basically layoffs. Continuing claims tell you how many people are laid off, how many people aren't finding jobs. So the two of them can give you some very, very good insights. And then, of course, there's the stock market itself. The market does process an enormous amount of information, and a lot of people that trade the markets do it with technical analysis. They don't look at the economic indicators; they look at charts. And I think what they're seeing is how the markets are interacting with the fundamentals, which is kind of what I try to do, but without charts, without technical charts, but rather combining markets and fundamentals together. So those are some ideas of what's important. But we put out we like everybody else watch every day. That we know what indicators are going to come out. We analyze them. You have a lot of charts on them. We have a lot of charts on them. Our charts are automatically updated. Yours are as well. and we look at them and come up to an opinion of, does this support our story? Does this support the roaring 2020s story? Does it support the 1990s melt up? Or does it support the, everything goes wrong scenario?
Thank you, Dr. Ed, for sharing these indicators. So bottom line, we watch the market movement because it's very high frequency, and sometimes it plays as a leading indicator for what is going on around the world. And all these data can be found in MacroMicro website and also Yardeni's website. So that brings us to the end of today's talk. A huge thank you again, Dr. Ed, for sharing your valuable insights from tariffs to Fed's policy stand to investment strategy. And also we talked about the impact of AI to the markets. So we've basically covered most of the key themes that will shape the financial landscape in the coming year. While uncertainties remain, Dr. Ed's perspective has given a clearer view ahead. So before we wrap up today's webinar, we have some exciting news. We're hosting a lucky draw. So simply watch and leave your comment below before March the 1st, and we will randomly select 2 lucky winners. One will receive a 1-month membership of MacroMicro Prime, and also other will receive a 1-month membership of Yardeni Research. So thank you all again for joining us at MacroMicro's webinar, and we hope you found today's session insightful and helpful in shaping your investment decision. Be sure to stay connected with MacroMicro and Yardeni Research for more expert analysis and updates. Until next time, take care and happy investing.